It is Markets with May, and today we're going to cover PacWest, Pacific West Bank. And it's so funny. I am hanging out in gorgeous Sedona. Got my travel straw with me. As you guys know, I'm always drinking some beverage. It's just San Pellegrino, okay? But I was gonna just kind of chill, maybe cover some of the banks and do a whole grouping of them on the weekends. And I looked at the aftermarket and I was like, this thing may not make it to the weekend. You're gonna have to cover this one way or the other if you want to cover the banks. And it's so depressing to me in some ways because this all really, I think, is avoidable. I know there's some people that are really seriously into raising rates for inflation. I think anyone that's following my Twitter knows that I don't think that the only way to fight inflation, given what's going on in the housing markets and the autos markets, is to actually just continue to raise rates given what PPI is doing. But that's a totally different video, okay? Today we're going to talk about Pacific West, which I typically do not cover, but started to go through the financials in preparation to just do a video on it since that is what has been requested, okay? But with the increase in rates that was done today, realizing that that's what exactly is putting pressure on the held to maturity assets that started all this off, I got to cover the banks. That's really what it is, because they may not be here in the next day or so. So without further ado, let's go into it. Currently, I have no position on PacWest. That doesn't mean tomorrow I won't do some fun stuff there. I do recommend, though, if you guys are going to do this, given what happened with First Republic, realize that it's not fun necessarily when you still have options on and something does end up getting taken over by the Fed. It will typically not trade all the way to zero, but as it moves from listed to OTC, there can be a day. And then the other thing is just make sure that your math works out. So I ended up doing diagonals, and because of the way the diagonals were done, I ended up making out just fine as far as that goes. In other words, I did diagonals that should not have been a credit that were done as a credit. So you got to be really careful out there so that you don't end up in kind of a mess. Yes, Corey, I see your comments, but you know I usually take comments at the end, and I totally agree with you. It shouldn't have been allowed to go bankrupt, but because it has, now all of the banks are on watch because let me tell you, First Republic was not the worst of the worst. All right, past performance, not indicative of future returns. Let's jump into this one. Bank failures is, I guess, kind of what everybody's on everybody's mind, because quite frankly, the markets can't really do much until all this clears. And I think that's really misunderstood. I want to revisit this. This was done by a Twitter account called Bury Tracker. I did not do this. You guys know I always give credit if I didn't do the work because I'm one lady, so I have to be nothing but thankful to everyone else. And I just want to remind you guys, PacWest, which is trading like absolute hell in the aftermarket, is actually not the riskiest one on here. What would have been risky is deposits greater than 250, the top bar of the chart. Deposits greater than 250 is uninsured deposits, number one. And number two, it's consolidation of very wealthy clients. That's what made Silicon Valley Bank, First Republic, and to a different extent, let's call it SB, Signature Bank New York, a little bit more risky. But realize, given where PacWest sits on this, they're not the worst. Unreal losses as a percentage of CET, that's changed and transformed magically for all of these guys. Israel, have a look at sorry, I'll try to focus on this. But if you look at where PacWest is relative to everybody else, this is how we started before the blowups. Okay, this was like immediately after Silicon Valley Bank. I think Bury Tracker put this out. It was a great chart, still one of my favorite charts that I've seen this entire time. But this is what it looked like. And a lot has been done to shift all of this around and reconfigure the banking system to kind of just address some of these issues. Deposits greater than 250 just means that it doesn't take as many people to walk out the door before you're crippled. And then unrealized losses, it just means that your held to maturity stuff can't be sold, because right now, given how much volume of that stuff is coming into the marketplace, you're going to take a ridiculous mark. So you need to hold it on your balance sheet. I mean, this would literally be the same as in 2008. I know a lot of folks in this entire that watch me remember 2008, because my average viewer tends to be a little bit older. But in 2008, if you needed to liquidate your house into the housing crisis, just because the sheer raw volume of homes that were available for sale was so high, it's a problem. Well, guess what? Every market behaves the same way, not the least of which is the debt capital markets. And in this case, it's every type of debt, because every single bank is now trying to do specifically the same thing, which is increase the amount of cash and sell whatever deposits they can at a loss. So that's the background. That's the backdraft for folks that are still trying to like set context. How did they do on the quarter? Well, it's been a minute since they reported, but I want to show you this. Revenue was down 5.5%. I'm going to go into detail. Don't worry, guys, because I think it's really important that people are clear on how to read banking statements, because banking statements historically have been really hard to read, and it shouldn't be. It should be easy for every person to do this analysis. You just have to kind of translate the jargon. So revenue was down 5.5%. EPS looked like a gigantic L, but I'm going to show you why it wasn't a gigantic L. It was actually net income was actually up 22%. And then if you actually back out the net income that's the net income to shareholders. There's actually more than one net income line, and we'll go through that. Return on equity looked like hell. This is part of the reason why during a bank failure, return on equity isn't my favorite metric. And this has to do with the reason why EPS was down, which was this gigantic goodwill impairment they took. We will talk about that. Return on common equity, tangible common equity, which also at different times is not the right metric or everyone's favorite metric, was crazy good, 14%. Now, PacWest sometimes does return on tangible common equity much higher than that. Don't worry about it right now, okay? Because they got bigger problems. And then book value actually increased. It was $18.90 of book value, meaning right now on the close, it's trading at 34% of book value. So 34 cents on the dollar book value. Charge-offs, small. Okay, your typical charge-off, you can kind of see down the line. They say on average for a regional bank, it's about 33 basis points. These guys are at 13 basis points. So there's really nothing wrong with the actual book. The charge-offs are up 10 basis points, meaning the charge-offs were even lower last year. You know, we had a lot of Fed money, helicopter money cycling around. And then allowances for credit losses increased a tad, okay? The fact is, though, they were releasing just like everybody else last year before we knew that the Fed would do this series of crazy increases in rates. And then CET capital, that should have came in as a percent. Sorry, my formatting isn't perfect. I'm one lady, and I'm supposed to be on vacation, quite frankly. So 9.2% was actually slightly up, on their way to 10% is where they were going. Okay, so that's what the picture looked like. All right, let me show you the income statement so you can really appreciate what's going on here. And unfortunately, this income statement, so I've got to toggle, joy of all joys. In order to get this really clear for folks, I've actually got to toggle between the deck, which does a much clearer job, the earnings release, which it is clear in different ways, and then like the 10K. And so it's like, so I'm going to do the best I can because, and you know, I actually think management tried very hard to be very clear on the call. Nonetheless, I mean, if everybody's still getting used to reading banking statements, then it's not going to ever be that easy. So don't sweat it. If this was hard for you, it should probably be hard for most people. So there's two types of income. Again, I'll just keep repeating this for people that are new to this. There's two types of income a bank makes, roughly speaking. There's interest-related income, and then there's fee-based income. And with interest income, often you have interest expense. And so that net interest income that everybody talks about is essentially kind of like a cost of goods sold number. It's like kind of a gross number. So your interest, is what you charge for the loans, so to speak. And then interest expense is the cost of your capital so that you get a net number. That's why I keep saying that's kind of like a gross margin, so to speak, or a gross revenue for folks that have real difficulty translating it. So that is one type of income. And then you also have to take provisions for credit losses against that as well, because that kind of goes in, let's call it escrow to help people out and translate this into words that are easier, they're more common for folks. So usually net interest, there's some people that will put net interest income and they will have the provision for credit loss above that. Some will have it below. Doesn't matter. It's broken out here. You can see it. Okay. So that actually was down on the quarter, mostly because net interest expense was much higher. We're going to go through that and why that is a little bit. And then you have the non-interest income up a lot and in many ways compensating for it. Now, if you were to compare it to last year and what it looked like, let me see. I have that because I wanted you guys to be able to see this clearly. All right. No, that's balance sheet. All right. This is going to make me really sad because I swear I had it for you guys. Okay, if you were to compare it to last year, you would see that it is actually up quite a lot. Here we go. Interest income up from 322 to 517. But because of the nature of the interest expense, which isn't broken out in the other slide, right? So 517 to 322 is a lot more loans over the course of the year. But look at the cost of the interest expense, right? So deposits, now they're, before no interest rate whatsoever. Now huge interest rate that they're giving you relative to the nothing that we all were getting before. But then also you have these borrowings and sub debt. And so we are going to have to go through that line item by line item to really understand if PacWest can survive the morning. And it still might not survive even if this is spotless, quite frankly. Okay. Because we'll get to that. All right. So that's, realize that the transformation of this 4.5% that no one, or 4.25, was 4+. Okay. That everyone keeps wanting to pretend like that didn't do it. That's not the issue. The issue is these banks are horrendous people. No, the issue is that your interest expense went up ginormously. That's part of the issue. And then the second part of the issue is that you end up with greater net interest income from it, but you end up really impairing every other asset down everything that was already written. That's the issue. So raising another 25 basis points, all I did was exacerbate this, which means that May, instead of enjoying the beautiful mountains of Sedona, which I will do, don't worry, it's just really hot at different times of the day, but instead of that, I'm covering banks. Is what's going on, okay, so that is that part of it. Let's go back to the income statement. Let me go through it. This is what did them in. This is a goodwill impairment, okay? 1.3, and they went ahead and took it. And what was that goodwill impairment? I'm going to blow this up because it was not clear, and you had to go look for it in the actual release. Let me just increase the size of this like crazy so you guys can see it, okay? Goodwill impairment of 1.38 billion recorded due to a decline in our stock price as a result of recent volatility. Goodwill impairment is a non-cash charge. It has no impact, yada, 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 yada. Okay, that's what that is. Okay, so if you remove the goodwill impairment, what is net income? The answer to that question is 171 million gain, which means that they made a crazy amount of money if it wasn't for the goodwill impairment. Okay, so everyone pretending like it's not so. And I just want to go back to this because I feel like people think that I'm joking or that I'm crazy or whatever it might be. I'm not. I'm not saying something that is that insane. Okay. If you look at any company, any bank that had enough capital to deal with this situation, or just had so much more massive, they're just not a target for deposits to leave the door because they have greater diversification deposits, you will see that revenue was up a lot. Net interest revenue plus fee revenue. Those two are the revenue line items that we're looking for, okay? And earnings per share was up a lot. And by the way, whether you look at return on equity or return on tangible common equity, that was up a lot, okay? So if the banks can survive, they do actually make a ton of money if you increase net interest margins, but it all depends on what kind of impairment they're going to take for the weirdness, and all of its paper, by the way, for the weirdness of the duration mismatch that they now have as we continue to raise rates, right? And we know that a 3-year, just to give you a sense for it, a 4-year will be something like a 12% mark on any loan, like for 3-year duration. I'll have to do a video just specifically on that to help you guys out. But basically, you're trading off one side, the income statement for the balance sheet is what's happening. And I don't know another way to say that because everybody else doesn't want to talk about the fact that the rates themselves are causing this banking crisis. But there it is, okay? You can see it clear as day. I have actually listened to every single S&P 500 bank at this point that is reported. Okay, so there's still a few consumer finance companies that I haven't listened to. Yeah, there's just a handful that I haven't listened to. I just haven't filled out this stupid spreadsheet, for lack of a better way to describe it. But more or less, anyone that isn't getting attacked looks like this. And by the way, in the absence of any actual credit losses, that also means that anyone buying these banks is making out like a little bandit. Okay, so let me go back to our story. Okay, so why is it that this 170, whatever it is, doesn't come straight down to the shareholders? It's because this is actually what happened. So this is the loss of 1.2. This is the goodwill impairment. Then there were some reorg acquisition integration costs from the past, right? And so you get to 124 adjusted earnings before income, and then realizing that they don't have, that can be written off against the tax bill. Then you've got dividends, you've got all this other stuff. That's how you get to 78, but that is still up significantly over the previous quarter. It's down year over year, but I mean, these numbers are funky right now. I don't know another way to say it. So this is the actual numbers. It's 118 versus 78. The impairment clocked them. That is what it is. Okay, so then what else do we have here? Okay, balance sheet. Balance sheet, the cash now is 6.6 billion and against total deposits of 28. And again, some people do not use this metric that I think it's weird because like one of the most common metrics that I'm hearing from my friends that still work on the street, they use this concept of CAPD, which is, cash as a percentage of deposits. Okay. So there's your cash as a percentage of deposits. They have made huge progress on taking care of uninsured deposits. Relative to, if you're a Pacific West customer, just if you're under the FDIC insured, cool. If you're not under the FDIC insured, be prudent. But I think most people at this point that are over 250,000, and again, remember, if you have multiple accounts, the Fed sums them up, for insurance purposes, that sort of things. Okay. So just realize that's the thing. All right, moving right along. These borrowings, you can see this is the increased, you could see that this wasn't there last year. Now it's there. Okay. I kind of love the amount of detail that they gave. So I will say that to the credit of the banks, there is a lot of detail. Now, this right here, this line item right here, which is investment securities is 7.2, does have a bit of held to maturity in it, if I'm understanding the way they posted this and then talked about it on the call. So that's 2.27 that you kind of have to take out of this liquid investment securities. My suspicion is they're just, securitized products that are not considered a loan per se, or maybe some sort of something else. Okay. Loans held for sale. You've kind of got this 2.7. So maybe also add back in securities available for sale. So you've got that. But realizing that if everybody's puking out assets at the same time, just like any other market, if there's more sellers than buyers, that's just going to be what it is. Your mark is going to include a little liquidity premium or a little liquidity discount, I guess in this case, since you're selling. So that's not great. Other things, I actually really like the way they broke this out, and I wish more would do it. But it does make it hard if I'm trying to create a deck by myself to do it because it's this gigantic spreadsheet of what everything's going on. But this I love because so many of you guys are still trying to improve your ability to read through and think about the balance sheet. What they did here was they gave you the rate of what they're experiencing for each component line item in the liabilities. And they also do the same thing for the assets. And remember, like I said, net interest income, which is your revenue line item, is just what did you make the loan for versus what did you actually get that capital for? And you can kind of see how that has changed over this period of time. So it used to be you got nothing for interest on your checking account. Now the average yield that they're giving is 3.2% versus last year 10 basis points. So I just really wanted to show this because this is excellent work on their part. I wish, it just makes it very easy to see. So that's just on the interest bearing deposits portion, of which a lot of their stuff is interest bearing. I mean, savings is such a small fraction of the big chunk of this. Okay. And then on the borrow, you can see that their rate of borrow on this is 5.3%, which is high given that they've got to actually lend out on the other side. Now, what kind of loans can you make such that you would more than surpass that 5.3% hurdle? Your average personal loan will be well over that, as will any kind of credit cards that you have that you've issued out as a bank, as the underlying bank, as well as different types of very specific business loans, or you got me. Okay. So this 5.3, it's not insane, but at the same time, that 5.2 billion is a big number relative to what they tell us is their loan book. So it's not the greatest, but the blended cost of capital does end up just being this 3.47 number. Okay. So then, yeah, so that's all I have prepared at this time. I think this number 3.47 still gives them a little bit of net interest, a reasonable net interest margin. But what really matters for them to survive the next few days is the deposits not walking out the door and the Fed not just forcing them to get married. Now, one of the better things about this particular bank versus a Pacific West or versus a First Republic is that this is only 20 something billion in deposits versus hundreds, or this loan book isn't that big. Okay. relative to 27, it's just not as big as First Republic is. So if someone just comes in and swoops them and takes their business by, whatever means, I hope they don't do it the way they did it with First Republic, which basically hung the shareholders and gave JP Morgan pretty much every return to get through it. But that's all I have prepared. I don't know if there's questions. Let's see. Let's see what we got. Big money. The big issue is big money being held in these banks being moved out by electronic transfers. I mean, yeah, that's true. I mean, if you can't hold your deposits, you can't hold your deposits. That's absolutely my point. So it actually doesn't matter. The real thing that you'll be following is the paper trail of who's buying this for dirt cheap, because quite frankly, I mean, since the shareholder got nothing with First Republic, I can only imagine that JP Morgan's bid probably, makes them a pretty penny when all this is done. Total debt is more than what could be covered by FDIC. I'm going to say that total bank debt at Pacific West, that, given like that, it's a little bit. Remember, the debt isn't the part that you worry about. It's the. I mean, just to calibrate for others, because Model 3 dude, you may already think of it this way, but I think a lot of people don't think of deposits as a form of debt. It is absolutely a form of debt. It has, and like the type of debt it is that people can pull it out immediately. So it's the worst kind of debt in some ways, although historically deposits didn't move out like that. But now we're in new times. The FDIC could cover the overnight, like basically all we're doing is transferring that duration mismatch from the bank to the FDIC. And then some banker is going to come in and buy the loans. And so that capital has to be there. But realizing that the more this happens, the greater frequency this happens, the less you're going to have buyers, because buyers aren't stupid. I mean, like, look, if you had a ton of cash in 2008, you waited half a beat until basically there were way more defaults. Just, you think like a private equity firm is somehow less intelligent than Main Street, who knew to do that as well in 2008. Come on. So we kind of, this whole continuing to raise interest rates because of inflation. I mean, I specifically think that different video, guys. But yeah, hopefully Model 3 dude that acknowledged and addressed what you're trying to say. That's right. Anything owed is debt. That's exactly right. Okay, cool. I'm glad we're on the same page. What can the banks do to fix the banking crisis? Nothing. Actually, at this point, it's too late. Okay. Like JP Morgan did actually say on their call that banks should not be holding any loans. They should just pass that right through. And then they're just basically a distribution network for the asset managers, if I'm understanding what he said on his earnings call correctly. But at this point, if you try to do that, you're going to end up holding a bunch of loans. And if you're confused that you're going to be holding a bunch of loans, then we only need a couple more companies to report out here that actually don't do debt as a part of their business, but are somehow magically holding more loans. I mean, go back and look at CarMax. Carvana will report up here pretty soon. We'll see if they were able to get the loans off balance sheet. Definitely GM and Ford. I don't know why no one ever bothered to look at that part of the balance sheet, because they do give you GM finance and Ford finance separately. But we had a little bit of an increase there as well for them. Now, I think that they got most of it off into the marketplace, but I think it was like $1 billion extra, in Ford. And then I have to review the financials fully of GM, so I'm not 100% sure. Don't quote me on GM, but yeah. So like, if you happen to have the capital, that's great. Now realize I'm not picking on Ford. I'm not saying something bad's going to happen with Ford Finance. The reality is that they have their capital isn't secured by deposits. Their capital is secured by the lending facilities that they already have from a while ago. So their format of funding is actually superior. But yeah, there's nothing that can be done at this point. What really could be done is you could lower the interest rate, which would immediately give back some of that capital that's currently being held to maturity. But you'd have to do it for more than one quarter. You'd have to do it and then chill out. One or the other would actually do it. But it kind of is what it is right now. No, actually, this won't work, Dave. It seems like this would work. Just fire up the printer and whatever. And yeah, for the FDIC. But the thing is, this is a misunderstanding about liquidity, guys. Okay. Bank deposits are not the major form of liquidity in the marketplace. Actually, all that juicy debt securitization that has to clear, that's your major form of liquidity. And it's really hard to capture it correctly. Yeah. Sorry. So there, it's okay. The banks have so if this is truly, if we're really talking about liquidity and duration mismatch and what it is, the deposits are the most durations. They're way up at the front, because you got to, when somebody wants it back, you got to give it back. So if you suddenly have a bank run, the deposits are the Achilles heel of any fractional reserve system. And then you have like 1 month, 3 month, you go on back, right? So oddly enough, some of the companies that are more corporations and their stuff is like 5 years. Okay, I'm just going to say it. I know some of you guys are tired of hearing me say it, but something like AMC, which actually termed out its debt, is actually in a better spot, in a lot of ways. Okay. So it's just, that's the nature of debt. Something like a GE Finance, their lending is not deposits. Okay. So they have some time that they can manage the mismatch. They have some time to refi. They can see it way in advance coming. But a bank run, you can't see in advance. It just comes like a tsunami. And then either you survive it or you don't. It's really horrible. The only thing that will stop that, given that there's no credit losses, is stop doing the thing that's causing it, which is raising rates. So yeah, hopefully that is like the simplest terms that I could say it. There was a ton of nuance. So if you're like a debt nerd, or if you're a Fed, macroeconomic nerd, maybe there's an easier way to say it. I'm just trying to simplify, but feel free to put in the comments greater clarification. I don't mind. Just be nice to me when you do it, as far as it goes, because I am trying to simplify. We got some AMC loves. Hey, Belle Biv DeVoe. Okay. My vacation is going great. It's really warm here. Thank you, Israel. Always appreciate your support. Belle Biv DeVoe. I got to throw it in there whenever I can, because I've taken so much smack for my AMC thoughts and support. Let's see. That's right, Juicy got you crazy. I did. I did. I'm just going to say it like it is. Okay. I think I got everybody's questions. I really hope. I really hope that I got everyone. I'm going to try to review more of the banks, but the key thing, if you're looking at them, hopefully some of the ways that I've described it in these videos helps you. You're going to want to look at the financing, realizing that regional banks by far, it's going to be deposits and then nothing so fancy. As you get into the credit card companies, which I will review at least one in the next few days, so you can see their financing is just a baby hair different. Okay, some of them do have deposits, but most of them are those receivables for the loans are going into a facility that's already been sold off. So it's a different, the nature of their risk is different. Now when they go to try to re-up it, so there'll be like a few quarters on this, when they go to re-up it, it could become a problem, but they have some time on that. So if whenever you have a liquidity crisis, it's whoever owes money first. Okay, it's kind of like if you're being chased by a bear, you just have to run faster than the guy behind you. It's like literally the same analogy. I'm sorry if my analogies are a little violent tonight. Let's see. Oh, that's so sweet. Yeah, you guys, thank you. Like, share, comment. I'm still trying to grow. And then I think I got everybody's questions. I'm really sorry if I didn't, but put them in the comments. I'll get to it. And that's all I have prepared for tonight. Good luck with trading tomorrow, guys. Bye.